We are currently witnessing the most capital-intensive infrastructure cycle in corporate history. In fiscal year 2025 alone, Microsoft committed $88.7 billion to CapEx. CapEx, or capital expenditures, represents the hard cash a company spends to acquire physical assets like land, buildings, and servers. Before we analyze the numbers, note that this breakdown is strictly for educational purposes. It is not an investment recommendation, and future earnings growth is never guaranteed. Historically, Microsoft achieved its high valuation by operating as a capital-light software distributor. They wrote code once and sold it infinitely at gross margins above 80%. The AI cloud demands a different physical reality. Deploying these models requires vast tracts of real estate, dedicated substations for gigawatts of power, and continuous shipments of premium silicon. This creates a direct tension between Microsoft's financial profile and its operations. They must figure out how to sustain the valuation multiples of a high-margin software business while rapidly depreciating tens of billions of dollars in physical hardware. To maintain profitability through this cycle, Microsoft relies on a specific architectural strategy, migrating customers up their technology stack away from hardware rentals and into higher-margin software layers. To evaluate the unit economics of this strategy, we can construct a theoretical baseline model using a 1 gigawatt data center. At the very bottom of the architecture is Layer 1, infrastructure. This functions entirely as GPU as a service. This base layer is a commoditized market, where Microsoft monetizes clients by charging for hourly bare metal consumption. Bare metal refers to physical computer servers allocated to a single tenant without any virtual software layers getting in the way. This visualization shows the underlying economics of that base layer. Assuming a standard 6-year depreciation cycle for the hardware, this layer yields a 15% ROIC and a 36% EBIT margin. ROIC, or return on invested capital, measures how efficiently a company uses its money to generate profits, while EBIT measures a company's core operating profitability before interest and taxes. Directly above that sits Layer 2, Platform and Foundry. This layer encompasses model-as-a-service offerings and data organization tools like Fabric. Fabric is Microsoft's unified data analytics platform that helps enterprises prepare their internal data for AI integration. The monetization model shifts here. Instead of renting hardware time, clients pay based on token consumption and PaaS subscriptions. PaaS stands for Platform as a Service, providing a hosted framework for developers to build and manage applications. This shift improves the economics to a 29% ROIC and a 52% EBIT margin. At the very top is Layer 3, Applications. This is Microsoft's proprietary first-party stack, including tools like Microsoft 365, Copilot, and custom agentic deployments. Operating on high-margin SaaS subscriptions and pay-as-you-go consumption, this layer reaches 54% ROIC and a 72% EBIT margin. The entire AI cloud thesis relies on this specific conversion. Microsoft must successfully turn 50% ROIC infrastructure renters into 54% ROIC application subscribers to justify the hardware costs. Looking closely at that top application layer reveals a divergence in how enterprises actually adopt these tools. For developers writing code, GitHub Copilot is proving its value with clear, measurable efficiency gains. This chart shows the strength of expert evidence regarding Microsoft's enterprise criticality. Alongside GitHub Copilot's 70 to 80% market penetration, notice the high confidence signals for Dynamics unseating competitors like Salesforce and Nuance Dragon DAX achieving 90% reductions in clinical documentation time. This diagram shows the direct contrast with general productivity tools. Microsoft 365 Copilot adoption remains at just 4 to 5% penetration. This chart shows the resulting tension in the commercial base. Focus on the red line, which tracks average revenue per user, or ARPU. Many enterprise clients currently view the $30 per user fee as a productivity tax, meaning they're paying to maintain access without a standardized, proven return on investment. With overall seat growth decelerating to 6%, Microsoft is reliant on upsells to premium SKUs, specifically E5 and Copilot, to maintain top-line revenue. An SKU, or stock keeping unit, is a distinct product offering, and E5 is Microsoft's highest-tier enterprise licensing package. Bridging the gap between a 5% penetration rate and widespread enterprise usage for M365 Copilot is Microsoft's most pressing operational priority. Beyond adoption rates, Microsoft faces pressure from the computational weight of new AI models. The industry is moving from simple text chatbots toward compute-heavy agentic workflows. Agentic workflows are AI systems designed to plan and execute multi-step actions autonomously to achieve a specific goal. To defend margins against this rising compute cost, Microsoft is deploying custom internal silicon. Using their own proprietary chips to run their own software removes layers of vendor markup from the data center. Simultaneously, they are managing a fleet of external GPUs. There is a counterintuitive economic benefit to constantly renewing their hardware orders with vendors like NVIDIA. NVIDIA's upcoming Vera Rubin architecture delivers 2.9 times more computing power than their previous Grace Blackwell generation. Crucially, NVIDIA is not raising the price of the new chips by 2.9 times. Because the performance gains outpace the price increases, NVIDIA is effectively sharing the productivity surplus with cloud providers. Even before Microsoft's custom silicon reaches full maturity, this pricing dynamic across the hardware ecosystem protects the viability of scaling complex, agentic AI. A persistent market concern is Microsoft's reliance on external partners. They do not wholly own a leading frontier model. A frontier model is a state-of-the-art AI system that matches or exceeds the highest average capabilities currently available in the industry. OpenAI's recent restructuring into a for-profit PBC clarifies the financial reality of this partnership. A PBC, or Public Benefit Corporation, is a for-profit entity legally required to balance financial returns with a stated public mission. Following this change, Microsoft's 27% equity stake is valued at approximately $135 billion. Microsoft did lose their status as OpenAI's exclusive cloud provider. OpenAI recently signed a $38 billion deal with AWS, gaining the freedom to operate across multiple clouds. However, raw language models are rapidly commoditizing. An LLM, or large language model, is the underlying algorithm trained on massive datasets to generate text. Without integration into existing workflows, an LLM provides zero standalone value to an enterprise. The actual competitive advantage lies in orchestration. An enterprise model only becomes useful when it is safely integrated with a company's secure, proprietary internal data. Microsoft's dominance in corporate data governance gives them leverage. Regardless of which specific model an enterprise chooses to query, they will likely route that query through Microsoft's architecture to ensure compliance and security, securing Microsoft's pricing power. Reconciling this architectural strategy with actual financial reporting highlights the immediate friction in the business model. Microsoft is bringing roughly 100 new data centers online per year, pushing their fiscal 2026 CapEx track toward $120 billion. This diagram shows the calendarized consensus view. Sustaining the current AI momentum requires an aggressive 62.2% jump in CapEx for 2025, followed by another 32.5% growth in 2026. This chart shows the immediate impact of depreciation and power costs. Look at the black trend line tracking the intelligent cloud segment's operating income margins, which compress from 44%. RPO represents the total value of future revenue under contract. As this chart shows, Microsoft's backlog has spiked past $600 billion. While Microsoft has secured strong long-term revenue visibility, the capital required to maintain this position suggests that margin compression is a structural reality. The final variable is external regulation. Microsoft faces active antitrust probes from the FTC and the European Union's Digital Markets Act regarding their cloud licensing and software bundling practices. Yet, strict regulatory environments often favor entrenched incumbents. As governments enforce tighter rules around AI data residency and security, enterprise clients are forced to rely on integrated architectures that smaller competitors cannot afford to build. The hardware transition compresses margins in the short term, but because modern enterprises default to the Microsoft ecosystem to solve their security and compliance requirements, the terminal value at the top of the application stack remains structurally intact.